Howdy, Jacob here. Today we're looking at 3M Company, 5.5% dividend yield. So above our 4% that we have as our screener. $60 billion market cap, $68 billion enterprise value, a little bit of net debt on the company. Huge return on invested capital. That's fantastic. Obviously, if they can find something to invest in, they usually do a great job of getting a return on that investment. Relatively flat business, 31 billion 10 years ago to 34 billion now. Looks like it's gone up essentially with inflation. Their dividend has grown every single year from 254 to 596. Let's see what that payout is. Roughly 3 billion, a little over 3 billion on the payout. Maybe 5-year average 5 billion or so. Yeah, it's like a 65% payout ratio. That's pretty manageable for a company that doesn't have a whole lot of growth potential. It looks like every couple of years they'll make a big investment for acquisitions. Otherwise, a lot of their use of free cash flow is on common stock and dividends. So although they do have a huge return on their invested capital, or a huge ROIC, it looks like they don't reinvest too much back into the business because again, they just might not have too many opportunities. 14 billion on the long-term debt, and we said about 5 billion average for a 5-year. So that's less than 3 years of their 5-year average free cash flow. That's not too concerning. They have 3.6 billion in cash on hand. Okay, interesting company so far. Um, 3M is one of those companies that just makes everything under the sun. I'm sure in your house you probably have hundreds. That might be exaggeration, but you definitely have some of 3M in your house, I presume. Founded in 1902, been around for quite a bit of time. I think we can start making some assumptions here. So I think I'm going to say it's going to grow roughly with inflation, maybe a little bit less. So I'll put 2% on the revenue. I think I'm going to do 14 on the P and price to free cash flow because um, I usually say a company growing 2% should be, roughly 12 for just a normal business. But again, we're saying that they have a huge return on invested capital. The company's been around for a while. People like consistency, and it looks like they're very consistent with earnings and free cash flow. So consistency and the ability to reinvest at these high rates of return. I might even put 15 for the P and price to free cash flow, just because again it's an art, so there's not necessarily science to why I'm doing that, but to me, I think it deserves a little bit more, a bit of a premium on a 2% growth, just because one, it's super consistent. Investors love consistency, and then two, if they do reinvest, they have a great ability to reinvest at high rates of return. 16, might just do 16 for both earnings margin and free cash flow margin. Let's say they buy back 1% of shares. And I will say that they increase their dividend 2% a year. I think that's I think that's reasonable. And that gets us to a price where it needs to fall 16% before we get a 15% return on the company with these assumptions. I think for now, I'm comfortable with this. Looks like I'll be doing research on it not too long due to it being 16% off the current price. I think for dividend companies, this is pretty good, pretty very, very solid company. I think you have good return, good ability to return on price appreciation as well. So definitely something I would be putting in my dividend yield screener to do more research on. But until then, yeah, I hope everyone has a good rest of their day and Happy New Year.